Everyone, it's Jack from Trading Matrix here. Hope you are well. This is our trade talk for the 13th of March, looking at a longer term time frame, sugar futures long. The reason we have entered this trade is because on a multi-month basis, sugar is in an uptrend. It's one of the strongest commodities and has been so far this year. Now in the chart here, you will see as we've entered into March, a drop down. That's because of the contract roll. It's not because sugar itself had a big gap down. So it does kind of skew the view of the chart a little bit. Nevertheless, looking at the continuous contract, which automatically smooths for the transition between contract months, we are in a robust uptrend on a multi-month basis. Because this is a longer term time frame trade, we're kind of looking to be in this one for several weeks to maybe even a couple of months. We've decided to express this one via options so as to be most capital efficient, to keep our capital to be able to do more intraday and shorter term time frame trading. So as a result, we initially sold a downside put spread, strikes 20.75 to 20.25. So we sold the 20.75 puts and bought the 20.25 puts back. This gives us a maximum loss already known. If we just sold the puts naked with no downside protection, well, that's a potential recipe for disaster. So we wanted to know our maximum downside. So as long as the market was to stay above that, which it currently is, towards the end of the expiry of the options, which these ones are tied to the May contract, so we'll be in May. Mid-May, the spread would make money. Nevertheless, on a shorter term time frame, more looking at the sort of intra-week perspective, we do see this market potentially vulnerable to a slight retracement lower. So as a result, we've legged into what's called an iron condor. If you're familiar with options, this is a structure you may very well know. Essentially, what it means is we're short a downside put spread and also short an upside call spread. So we sold the 21.50 to 22 call spread. So that means that if the market stays within the 20.75 to 21.50 range at the expiry of the options, as long as it's within those, we will yield max profit. Won't potentially stay in this all the way to expiry. We will be managing it on a week-by-week basis. But for now, this is something we're happy with. We are bullish sugar. Like I mentioned, it's one of the most bullish commodities of the year so far. And selling that topside spread just adds a bit more premium into the portfolio and ultimately lowers the max downside risk. Won't be bringing you a day-by-day or even a week-by-week update on this. It may be 2 or 3 weeks before we revisit this one. We shall see. But yeah, just to let you know that this is a trade we've taken. Thanks for watching. Wishing you a pleasant day and see you again very soon.